You look down at your phone, a line on a chart turns green, and your brain gets a sudden rush of dopamine. You buy. 10 minutes later, the line flashes red, panic sets in, and you sell. When you react to those flashes of color, you are following a chemical impulse shared by millions of other people at the exact same moment. This collective synchronization creates a herd that moves together, often directly into the path of a loss. This is the core of speculation, buying into hype, whether it is crypto, NFTs, or the newest AI startup, strictly because you expect to find a greater fool who will pay more for it tomorrow. Stopping the bleeding requires a complete rejection of the market timing habits pushed by financial influencers and social media trends. Chasing the hype cycle is an emotional game of hot potato. It is a system where the majority of participants are mathematically likely to be left holding the asset when the excitement disappears. We see this play out whenever a new asset class explodes. Investors flood into digital monkey drawings or unproven tech companies, convinced that the upward momentum is permanent. Maintaining this lifestyle is exhausting. It forces you to stay up until 6 a.m. scouring Reddit forums and trying to buy the dip before the rest of the world catches on. But every bubble eventually runs out of new buyers. When that happens, the hype vanishes instantly, leaving the active trader with a worthless asset and no exit strategy. Success in speculation requires you to perfectly predict mass human psychology and market timing over and over again, a task that is statistically impossible to sustain over a lifetime. The risk of ruin escalates significantly when you use leverage. Borrowing money to trade turns a standard market correction into a total portfolio wipeout. Consider a margin loan. Invest $10, borrowing $90 to buy a $100 asset. Rising prices multiply your equity. But a 10% drop shrinks your position to $90, exactly your debt. Your $10 vanishes. The bank takes the rest, leaving nothing. Using leverage means that standard daily market volatility becomes a terminal risk. It effectively guarantees that a single minor dip will eventually reset your balance to zero. Exposing your wealth to these kinds of sudden wipeouts is a fundamental error. It is a vulnerability similar to how most people leave their personal data exposed through standard mobile carriers. This is where Cape comes in. Cape is America's privacy-first mobile carrier, engineered to protect users from SIM swap attacks and voicemail hacking, the tools hackers use to hijack financial accounts. Cape runs its own secure core network, rather than just reselling access to compromised systems. This stops carrier-level data leaks at the source. Securing your digital identity provides the foundation you need before you can build long-term wealth. Visit the link in the description for 33% off. If we move away from the high-stress world of stock picking and market timing, a much more stable strategy emerges. This is the index fund, a tool designed for structural stability rather than short-term gambles. Instead of betting on one company, an index fund places your capital into a single basket containing the top 500 market companies. If a few companies fail, the overall impact on your investment is minimal. The diversity of the other 497 keeps the basket intact. This structure ties your financial outcome to the aggregate growth of the entire economy. It replaces the high-risk gamble of a single company's survival with the historical resilience of the broader market. To manage this, you need a behavioral failsafe that bypasses the brain's impulse to panic. We call this dollar-cost averaging. You invest a fixed amount of money at exactly the same time every week, regardless of what the charts look like. Whether the market is at a peak or a trough, the investment happens automatically. This removes the need to watch the news or check trading apps. It takes the emotional weight of decision-making out of the equation entirely. This method is undeniably slow. It lacks the excitement of a potential overnight moonshot, and for many, that makes it incredibly boring. But by leaning into this automated discipline, you stop acting like a member of the panicked herd. Over a 40-year horizon, this consistency creates a compounding advantage that